Most traders open TradingView, add indicator to the chart, follow the colors, and at first, it actually works.
Oh yeah.
They get a few wins, confidence goes up, and then suddenly it starts falling apart. Losers shows up fast, especially when the market goes sideways or when trades go against the trend. And this is where most traders get stuck, because the indicator itself isn't broken. The real problem is how it's been used. In this video, I'm going to show you how to turn almost any TradingView indicator into a simple clarity-first strategy that actually works for scalping, day trading, and swing trading. We'll use one free indicator as the example, the dynamic Z-score deviation indicator. But the rules you're about to learn fix the exact mistake that causes most false signals. And the important rule doesn't come right away. So if you skip ahead, you miss the part that actually changes results. This indicator was originally designed to generate reversal signals. And this is where the most traders immediately fall into the trap. The problem is, reversal signals looks amazing, but in real market conditions, they consistently fight the trend. So instead of trying to make this indicator smarter, we're going to make the rules around it smarter. But before we touch anything technical, quick disclaimer. This is not financial advice. This is purely educational, showing how to structure a rule-based TradingView strategy. Now, the first thing we do is remove the noise. Open the indicator settings. Go into the inputs and disable the option that shows reversal signals. We don't need them. Next, set the shadow layer count to 1. Then, disable a smooth color transition. What we're doing here is forcing the indicator to be visually clean and mechanically readable. No guessing, no fading colors, just clear structure. At this point, a lot of traders would already start buying and selling purely based on color changes. And to be fair, that can work in a strong trending markets. But this is also exactly where trading accounts get damaged. As soon as the market starts ranging or momentum slows down, those color changes turn into random signals. Even worse, sometimes they push you directly into counter-trend trades. That's not the flaw of this indicator. This is the flaw of using it without context. So before we even think about entries, we solve the biggest problem most TradingView strategies fail at: direction. In every scalping, day trading, or swing trading strategy, the first decision is trend. If you get that wrong, everything after it collapses. To keep this simple and consistent, we use a 300 exponential moving average indicator. It doesn't matter what market you trade or what time frame you're on. Here's the rule. And this alone removes a huge percentage of losing trades. If the price is above the 300 EMA, the trend is up, and we completely ignore all sell signals. And if the price is below the 300 EMA, the trend is down, and we completely ignore all buy signals. This single rule eliminates counter-trend trades. But even after fixing trend direction, there's still another problem that destroys results: ranging markets. This is where most buy-sell indicators slowly bleed accounts. So instead of reacting to color changes, we change how we use the indicator entirely. We do not enter trades just because the color flips. That's the mistake most traders make. Instead, we wait for price interaction. We wait for price to actually retest the color band itself. Let me walk you through this on the chart. Check out the chart. The price is below the 300 EMA, so we're clearly in a downtrend. We're not selling every color change. We wait for price to move back up and to the band. We want to see candles printing inside that band. The retest is critical. Most traders escape it because it feels slow, but this is where weak signals get filtered out. Now, here's the trigger. And this is the part most people miss. After the retest, we wait for the price to break back below the lower band. That break is the sell trigger, not the color, not the touch, the break. This shifts the strategy from reactive to confirmational without adding indicators or complexity. Risk management stays mechanical. The stop loss goes above the upper band or above the most recent swing high. The target is set to 1.5 to 2 times the risk. Nothing fancy, just consistent execution. As you move forward on the chart, you see the same pattern repeat. Price retests the band and then breaks below it again. Every time, the rules stays exactly the same. No distraction, no guessing. Eventually, the market structure changes. Price moves above the 300 EMA, and that's your pivot. From that moment on, you stop looking for sell trades entirely. Now you only look for buys. Price pulls back into the band, candle prints inside it, and then price breaks above the upper band. That breaks as your buy trigger. The stop loss goes below the lower band or the recent swing low. And again, the target stays at 1.5 to 2 times risk. This is how you turn a TradingView indicator into a real usable strategy. Not by adding more signals, but by controlling when you're allowed to listen to them. And if you want to see an even more stripped down approach, check the video on the screen now, where I break down the simplest trading method I've ever used, especially for beginner traders who want clarity without confusion. Happy trading!